Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. First and foremost, I want to wish all of you a happy and prosperous new year. For the FANGs, almost anything might be considered better than what happened in 2022. Happily, for the first few days of 2023, the FANGs have been either rising or hanging in nicely. Have they found their footing now, or can we look for more of the very recent same? Or do we still need to exercise a lot of caution as the year progresses? Well, let's take a hard look and see. Before we do, I personally want to thank everyone who made it out to our January 2023 webinar last Friday. We had a full house talking SVA, and it was great fun with some good questions. Also, welcome aboard to those who joined our investment community. We are happy to have you as part of our family. And if you would still like to take advantage of our limited time offer, go to www.strategicanalysis.ca/pricing. If you missed the webinar but would still like to watch the recording, I will show you how to tune in later in the video. Now, on to the FANGs. To start with, our market index work, the NASDAQ 100 in particular, is far from showing signs that a bottom has been reached. Indeed, the fair market value of the NASDAQ 100 is suggesting that an additional 20% of downside risks remain in that index before I can even say with a modicum of clear conscience that the coast could be seen as even being somewhat clear. If things work out as history points to, and as I suspect, a powerful and possibly sustained rally point does lie ahead, but that is not from today's valuation level. In the last FANG Friday of 2022, I left you with a number of things to watch for. So I will update you all to let you know where those stocks stand today and what we might expect going forward from here. While it has not been a good year for investors in the NASDAQ 100, the simple secret to avoiding trouble last year was just to avoid poor values, not necessarily being out of the market. A good number of value stocks have actually had a good year. So despite what you've seen in our FANG Friday webcasts in the past year, I am not now a perma-bear, but I am and remain a perma-value investor. Now, we've managed to miss almost all of the carnage among the FANGs, and we've even managed to catch a couple of bounces as well. For FANG Friday subscribers, last year has been a pretty good year. And it would have been better still for anyone who had gone short the FANGs that SVA told you to avoid. I do not recommend short selling in our client service, but the opportunities were there, and there in spades last year. The question now is, what's ahead for 2023? But before we take a close look at those FANGs and what's going on, as always, I do like to say thanks to everyone who likes this video and all our subscribers. Okay, well, let's start off with, I guess, what I might call my favorite FANG, which is Netflix, which continues, I think, to rise towards its bubble price. Just late last week, the stock had another setback to its mid-super growth price. That's 5.5 times book value. But again, it has bounced there and looks very much as if it's heading for its bubble price. Note, by the way, that it had already closed that gap, okay, way back in April of 2022. And if today's action is any guide, is steaming higher. Meta, I was a little bit nervous about late last year in our last December forecast, as the stock had not broken out over its mid-growth price after a nice bounce up from its growth price low. However, this week it has indeed broken out, and we might well therefore look for a move higher, perhaps even as much as its super growth price. You know, bearing in mind, when you look at how the stock has performed, the stock actually had fallen some 73% from its peak in 2021. And a decline of that sort tends to attract kind of the bottom seekers there, and so perhaps we have got a bottom in Meta. Now, when I look at the trend of the fair market value, of course, it is still down, and in fact, actually has been accelerating a little bit. But as I say, after a decline of that magnitude, hope springs eternal. Amazon, by the way, demonstrates quite a normal pattern, which some time ago on FANG Friday I showed you with Coca-Cola. That is a pattern where big growth stocks, when they come down in stages, and it's typically 2 down, 1 up, 2 down, 1 up. And so far, Amazon has been following that pattern. This latest 2 down has taken us to the mid-super growth price, which is 5.5 times book, and has been rebounding since. I don't expect it to get above its bubble price, particularly when I see the steady and powerful decline in its fair market value. Tesla, well, Tesla after an astonishing 70% decline, hit its bubble price, and again, you know, like Meta, a decline of that magnitude almost begs bottom fishers to get back in again. And on top of all that, of course, the bubble price is one of the very, very strongest valuation levels in all of SVA. So for the time being, Tesla appears to have found a bottom. However, there is a but to it, and that is to say that the fair market value is slipping, and there are some elements there which give me some concern. Alphabet, after its peak at its bubble price, continues to sort of trade raggedly. Okay, this is what I call kind of ragged, indecisive trading. Okay, it rather than precise at a break point, it sort of meanders back and forth. As I say, that's indecisive trading. Well, we had some more indecisive trading here too. But it now looks as if it is heading on down to its super growth price, where, by the way, again, a very strong breakpoint. I would expect a good support and a nice trading reaction. Microsoft is virtually the same story as Alphabet. Again, we got a perfect sell at its HB3. Failed at, which by the way is 16 times book, failed at its HB2, which is 12 times book, and after a little bit, again, of indecisive sloppy trading, has broken down again. Again, I expect, just as I expect with, or saw with Tesla and with Amazon, I would expect when we get to the bubble price, we are going to get ourselves a nice rebound. So keep that very much in mind. NVIDIA looked very much to me as if the stock was breaking down, and indeed after its lovely rebound to its HB4 or 20 times book value, it looked as if it was fading there, and indeed failing at its HB3, which is 12 times book. Well, as it turns out, however, there's been one heck of a rally in the Bitcoin, and I think it's pulling NVIDIA back on side despite its poor intrinsic value. Finally, about all I can say as far as Apple is concerned is that if we extend this line here, that the HB6, which is 33 times book value, if we extend that line down, assuming that share buybacks remain in place, then the stock looks to me as if it has kind of remained on side over its HB6 price. That's kind of thin consolation, however, given the fact that the stock remains very, very much in a downtrend. Now, in summary, we are now in the early stages of the earnings reporting season, and it will be important to see whether or not some of these weak fair market value trends that I showed you, the dotted line and the charts, continue, accelerate, or level out. We will probably need about another 2 weeks before the majority of the FANGs are in, NVIDIA always being a latecomer. And I would therefore expect that the market may hold its breath as it's been doing for the moment. In summary, let's review the FANGs, and we'll see what you should be watching for this year. Netflix, my favorite FANG, plunged almost 80% following my sell when it broke its HB3, bottomed roughly at its super growth price, although not precisely as I've observed many times. It's had a nice rebound, closed that trading gap following the collapse through its bubble price. In December, I told you I was still wondering whether those shares wanted to go back to its bubble price, as frequently happens in this situation, or whether closing the gap was enough. I have to say that it looks today as if Netflix wants to finish its move to its bubble price after a setback too, and a perfect rebound up from its MSG price, or 5.5 times book. Meta was a clear sell at its bubble price, 7.4 times book, and bottomed roughly at its growth price, or 2 times book. Total loss of 73%. It's since enjoyed a one breakpoint rebound, but I thought it was maybe running out of gas. In December, I observed that I would not be holding Meta shares right then. But if they managed to break out over their mid-growth price, or 2.5 times book, it would certainly be promising. Well, they did, and it is. Amazon did manage to hold at its mid-super growth price, that's 5.5 times book, as it had at its bubble price one level higher earlier, and it's been rallying since. I had suspected that the game might be over, but that had been proven to be wrong in the very short term. The bubble price would be all that I could vision right now, however, and I await the first quarter earnings with considerable interest. Virtually all aspects of the company look to be weak, and the company appears to be agree with that with their massive layoffs and canceled expansion plans. Even cloud computing is in the doghouse these days. I would exercise considerable caution going forward. Tesla found support at its bubble price for the time being. The challenge of looking at its current fair market value measure level as evidence that a bottom is at hand is that the company is now trying to boost demand by price cutting. That bespeaks a lot of sales pressure. Not surprising, given the plethora of electric vehicles on or coming to the market, many with better quality records than Tesla enjoys. And someone once observed, the problem with being a pioneer is that too often you wind up with arrows in your back. I can certainly understand why Elon Musk has already sold some $40 billion of his stock. What you must now watch for is whether the bubble price, that's $106, can hold. Breaking that level leads us to a deep, dark place, as we may be seeing with Amazon. Alphabet was a clear sell at its bubble price, and Microsoft was a clear sell at its HB3, or 16 times book. They are down 42 and 31% respectively, somewhat in line with the NASDAQ 100. They cling like cloth to their critical breakpoints, and both have let go. Stand aside for the time being. I am, however, pretty sure that Alphabet is likely to have at least a solid, decent bounce at its super growth price. So you might get a nice trade here, as the super growth price is very powerful support indeed. Microsoft will also likely get a bounce at its bubble price, as have Amazon and now Tesla. So you can book both of those as highly likely rebounds. As far as NVIDIA is concerned, we got a perfect sell at its HB6 price of 33 times book. That valuation level, by the way, that went all the way back to the year 2000 peak. In December, I said that if the HB3 price at 16 times book failed to hold the shares, as I suspected would happen, the trip down to its bubble price that I promised you some time ago would undoubtedly transpire. Well, the HB3 price did fail. But in the current market rally in this past week, the shares have managed to claw back on side again. And perhaps small wonder, Bitcoin has had one heck of a rally back to and over 19,000, up from roughly 16,000. So maybe the hunt is back on. Last and certainly not least, Apple remains everybody's favorite stock, and their share buyback program has kept the stock valuation higher than it merits. Apple has only lost about 24% versus the 31% for the NASDAQ 100. So I was perhaps right not to bail out. But that did not offer much comfort. Remember what I told you about a former partner of mine at Scepter Investment Counsel who once observed, relative performance can make for some tough chewing. Since December, if you followed my advice and extended the line down for the HB6 price, that's 33 times book, and tried to guesstimate where the breakdown might occur, you'd still be in the shares. Otherwise, my advice was to do what I intended to do. Forget about it. Let me point out, or conclude by pointing out, that the NASDAQ 100 has not yet found a sustainable low, and I need to emphasize that I have never seen a solid market bottom that has not come until one of our key SVA breakpoints has been reached, and we see some solid upside potential being reflected in those fair market value lines on each of our charts. Those are dotted lines. I can promise you that a really good trading opportunity lies ahead, however, but that is not right now. Right now, I would personally remain cautious and watch those breakpoints for evidence of support or failure. If you want to learn more about SVA and missed our introductory webinar, you can click the link at the end of the video right here. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.